Good morning and thank you everyone for joining us for our weekly research morning call. Today's agenda will have Sembcorp Marine, followed by Alliance Healthcare Group, Phillip on the ground. Then we'll go through some technical analysis on AEM and UMS, followed by the yield curve. And then we'll touch on our reinitiation of city developments and end with Singapore Weekly and more Phillip on the ground on HRnet and United Hampshire US REIT. Without further ado, I'll pass my time on to Terence for Sembcorp Marine.
Yeah, thanks, Timothy. Sembcorp Marine announced the issuance of and the results of their $1.5 billion rights issue. In our next slide, value acceptances accounted for 84.2% of the total rights issue, whereas excess applications accounted for 33.5% of the total rights issue. In total, value acceptances and excess applications accounted for 117.7% of the overall rights issue. Before we continue, also do take note that we do not have any active coverage on Sembcorp Marine. In our next slide, Temasek Group will incur the compliance offer obligation. Temasek will receive its pro rata allotment of 8 billion shares as well as excess allotments of 1.2 billion shares for a total of 9.3 billion shares. Temasek Holdings will take up 49.3% of Sembcorp Marine's rights issue, taking its stake to 46.6%. Before the announcement of the rights issue, its stake of Sembcorp Marine was 42.6%. This means that Temasek has incurred an obligation to make the compliance offer for the remaining shares not owned. We expect the announcement of the compliance offer to come after the listing of the shares on the 22nd of September this month. So that's all from me for Sembcorp Marine. I'll now hand over the time to Vivian.
Thanks, Terence, and good morning, everyone. So this is a brief summary of the POEMS webinar that we had with Alliance Healthcare last week. We do not have coverage on the counter. So firstly, a brief introduction of the company. If you refer to the picture on your top left, they currently have 5 main segments. So in anti-clockwise, the first one is Managed Healthcare Solutions, under which they provide healthcare services to the employees of corporations and insured members of policyholders. Then there are the GP Clinic and Specialist Care Services. So they have a total of 16 GP clinics island-wide and 5 specialist clinics, including those of ear, nose and throat, ENT, and orthopedic. Next is pharmaceutical services. So under this segment, they engage in wholesale distribution of pharmaceutical products to various medical institutions. Lastly, there is the mobile and digital health services, through which they provide medical care through mobile and home care services. So let's look at the POEMS webinar highlights on your bullet points on your top right. For GP clinics and specialist care services, this segment contributed half of FY21 revenue, with 30% from GP and 20% from specialist care. The revenue from GP clinics was impacted during the circuit breaker, and it was down during second half of FY20 and first half of FY21. So basically the whole period from January to December of 2020, before recovering in second half of FY 2021. So if you refer to the charts on your bottom left, you can see that the blue bar representing the revenue for first half of FY21 and orange bars representing the revenue for second half of FY21. The revenue from GP clinics slightly increased by 14% to 7.5 million in the second half of FY21, ending June 2021. And it was impacted again during the heightened alert. So footfall hasn't quite recovered back to pre-pandemic levels. For the pharmaceutical services, which contributed 28% of revenue, there was a spike in revenue comparing to FY20 for this segment as various medical institutions stocked up on their medical supplies. But the management also shared that this has been easing, and this is due to the fact that some of these hospitals or polyclinics realize that they have overstocked. So this is also why you see that the revenue for this segment comparing first half and second half was down about 20%, but at $5.6 million, this still remains above pre-COVID levels. For the last segment, which is mobile and digital health services that contributed 9% of the revenue, they are actively developing this segment as the management shared that with expectations of life going into a new normal, they are also not expecting for footfall at GP clinics to go back to pre-pandemic levels. And teleconsultation would then be part of the new normal where people receive consultation online. So under this segment, they have two apps. The first one being Jagami, through which patients could get access to healthcare services at the comfort of their homes. So you could engage healthcare professionals to go to your homes for home cancer treatment, home vaccination, or do the PCR swab tests. And also they also provide other home medical and nursing services. The second app is Hey Ali, through which they provide only teleconsultation services. So those, including those of nutritionists and psychologists, which are among the areas that are going increasingly digital. Looking forward then, they would also continue to explore other specialists to the current list, to add to the current list, and many opportunities lie in this area, especially with the aging population. So government expenditure on healthcare is expected to increase to 18 billion Sing dollars in 2022. And they would, for Alliance Healthcare, they will also be continuing the development of the digital platforms as patients are demanding higher levels of convenience and personalization through the smartphone technology. So that's all for Alliance Healthcare Group. I'll now be passing the time on to Wei Ren for technical analysis.
Hi, Vivian. Thank you very much for sharing. Okay, so basically today I'll share some of the yield curve history and then goes on. So without further ado, let's start on with the yield curve. So if you can look from the chart which shown clearly, right, that basically I want to share about is what is happening in 2008, 2006, 2007, 2008 period, and then what happened recently at 2020. All right, so in this case, right, you can look at the yield curve inverted back in 2007. And subsequent rise in yield peak and corrected in February, between February 08 to March 08 period. And then this subsequent upside peak in September 08 and forced the S&P 500 to have a very huge correction down, which you can see from the very clear dotted line in 08. Okay, so then after that we bring back the attention to the current present day, which is the 2020 COVID sell down. The yield, you can look closely, right? The yield movement actually greatly resemble what happened in 2007 and 8 period. So hence, on the prediction front, should the yield curve pick up, rise sharply, and then the S&P 500 on the broader market on this weekly chart, it correct down. This is a monthly chart, by the way. Sorry, it correct down. Then it will actually increase the probability of a larger than expected correction. So in this retrospect, right, that it should in this retrospect, during this quadruple watching is or aka the triple watching period, where by the option, the three asset class, the stocks, options, and the future expiry at the same time altogether, traditionally September and October seems to be a correction month, especially last year where Dow actually corrected 1,000 points in September, first week of September itself. This September 2021, not much, although there's some slight down, but it's not really constitute as a very major correction. So hence, I think we shall look at is October. All right. So on the next slide. So this one is basically the Dow Jones Industrial Average monthly chart from 1986 to 2008. I factor in the Elliott wave theory. So we can see that from 1986 all the way to year 2000, before the dot-com bubble burst, okay, it actually completed the five-wave primary phase of the cycle phase of wave one. Then subsequently, the dot-com bubble came down. It's a larger corrective A, and then B, C. B, actually, how we confirm the wave B is because if you do the Fibonacci extension, although the upside from 2002 onwards until 2007, during this 5-year period, it experienced a very strong bull run. But the bull run wasn't that great, fantastic, because it didn't really clear above 161.8%. Take note of this number and this Fibonacci extension number, because this will really, I'll explain further why it resembles last year 2020, and then going forward I'll explain how the market is going to be like. So but right now we bring back the attention back, and then subsequently 2009 it recovers after that. So on the next slide will be 2008 to present days. So you can see that the wave 3 wasn't that a large expansion. So therefore we think that there's a possibility that ongoing wave 5 or the cycle phase, which I marked out in the arrow, we can see that there is a possible extended wave 5. And then what does this mean? That there's a probability that in the longer term, until 2023, we should see Dow actually clear above 40,000 region. All right, so on the next chart will be the weekly chart. Okay, so weekly chart, you can look at the wave D. There is actually a mini double top, which was happened between January and February 2020 last year. All right, and then there's a mini divergence, and then price actually gapped down and then rebounded subsequently. This greatly also, they sell down last year, also resemble what happened in 1987 October as well. So if you shift to the right, you look at the present moment. Currently, I think that we are experiencing a corrective kind of momentum. So we expect price, deepest correction that we have is at 30,000 before a rebound to the upside. All right. So on the next slide, you can see that the chart is not really that clear, but however, I just briefly touched through. This is just to show the similarity between what happened in 1987 and then what happened in 2020. And then from this, we can expect that over the longer term run, right, that currently we will expect, like what I shared in the money chart, that price is likely to go beyond 40,000 in the longer term. But of course, on the shorter term, right now, you can see the similarity, which happen on the next slide on the 1987 chart. I will use it as a reference. All right, that you can see that towards on the far right, you can see that there's some consolidated period going on. So we expect that currently right now, there's a high chance that that with the tapering and the macro environment, inflationary pressure, we expect that the last quarter of 2021 to be in a very much of a corrective range before we embark next year for rebound again. All right, so with that, I end off my presentation. So I'll pass my time to Paul. I'll do AEM Holdings and UMS Holdings as well. So so apologies for that. Okay, so for AEM Holdings, you can scan on your right for the report that I posted on 4th August. So the head and shoulder formation is actually invalidated right now. So we expect some sort of like upside pressure for AEM Holdings. All right, targeting at $4.75 on the longer term period. Okay, so this is what I have for AEM. Next slide will be on UMS sharing. Okay, so for UMS, I think you can see that there's a multiple resistance being tested, and it forms a symmetrical triangle, or you can forms like a pennant. All right, so you can see that from there, the multiple resistance has been tested multiple times. All right, and that this clearly shows a very weak, a weakening in the resistance zone. Hence, we believe that that there is a possible upside to come. Should support zone at 1.64 to 1.67 remain supported. All right, or look out for any breakout above the resistance zone. This will give a very strong indication that the bullish momentum is confirmed. All right, so with that, I end off my presentation. I'll pass my time to Natalie for city development. Thank you.
I don't think, because Natalie is in the CI, the Capital Land briefing. So let me just try to brief for her. Okay, can you go back let me go through my weekly first. Then if she's not in yet, then I will just go through the city development. Yeah. So sorry everyone for the, because she's busy now with the Capital Land briefing. So she has to. It's a physical meeting, so that's why she can't be with us for now. Okay, let me just run through our usual macro updates. For Singapore, there was quite a number of data points. Because we are focused more on the industry data points. So for healthcare, there was numbers from dental numbers. So for July, the dental admissions was up 18%. So that's a positive, because year on year it's still up 18%. Hospitals are still lagging, but I guess it doesn't really matter since the hospitals are relying a lot on the government programs. We had some SIA passenger traffic numbers. I think no surprise. I think the compared to pre-pandemic, we are only about 7% off the pre-pandemic. That means August last month was 133,000, whereas a year ago or 2 years ago was 1.9 million. The other data point we like to monitor is the ready-mix concrete RMC, because this is important as we have a buy call on Pan United. The numbers are still trending well, so we have almost a million metric tons, and that's 10% below pre-pandemic, which is surprising. So despite the difficulties faced by the construction industry, the demand for ready-mix concrete remains robust, I guess. There were some numbers on employment. Employment, they gave a flash number, but this time around the full numbers were here. I think what was caught our attention more was the vacancies. So for the June quarter, because these are quarterly numbers, the June quarter vacancies in Singapore, job vacancies was a record high. There was a 20,000 decline in jobs, mainly from construction and also services, but it also reflects we'll show you charts later, we'll explain later a little bit. The next one is just for the property market. The new launches remains healthy, although it was down year on year, but no down year on year was just marginal, and compared to the month ago, I think you cannot match those numbers at 1,006. Year to date, properties is still strong, it's up 50%. For us, I mean, as a rule of thumb, I mean, right thumb or left thumb, but as a rule of thumb, anything above 1,000 is considered a very healthy market, because usually sales excluding EC is usually around 10,000. So anything above 1,000 is actually above trend. There were some export numbers. We'll show you a chart later, but overall it's still healthy. I mean, trajectory for exports in Singapore is still strong, and elsewhere too. In the US, we just monitor since it's such an important market. There's a lot of talk now of increase of corporate tax. It's just for information. I mean, the implications, I'm not a US ready, so I can't really get the numbers out here. But in terms of the impact, you can see that there are plans for corporate tax to increase capital gains tax. So there is I'm not sure if it's a negative headwind, but there is this thing being proposed right now. We'll discuss later why the inflation numbers is quite a meaningful number, something to monitor. We'll discuss later on the POEMS webinar. For us, technically, I think the outlook is still good. I mean, when we look at most of the macro numbers, except for China, where things are slowing down the momentum, but across the board, we still see generally healthy macro picture. And with the borders reopening, I think we can see more and more countries trying their best to reopen their borders. This should be another growth catalyst for the markets. Just that we might need to build some inflation buffer, because we still think interest rates look a little bit low compared to the historical inflation numbers. We'll show you a chart later. For the important events this week, I think the big one will be the FOMC meeting. I think everyone knows it's all about the tapering. What is the base case now? So the base case is that they would start tapering in December. Tapering means they will not buy so many government treasuries and mortgage-backed securities. They will stop. Doesn't mean they're going to raise rates. So they're going to reduce their purchases from December of this year until October of next year. So that's the base case. I mean, it depends whether 10 billion, 15 billion, but I mean, this is just what the expectations are. So I don't think even if they announce that, the market might get too surprised, because it's really kind of factored in. So they've done a good job in communicating their plans. The other thing is just our usual POEMS webinar. We have 3 this week. So Comfort is a buy, and also Asian Pay TV is a buy. So Comfort is tomorrow. and I think Asian TV is the day after. But yeah, so if you have time, no, feel free to register for all this. Next slide. Okay, in terms of the pandemic, we are looking at global cases. So the good news is coming down. And the other thing is, again, this is a bit of a morbid number, but we decided to also look at the mortality rates, because this will also kind of give confidence to, I guess, the governments globally that they can start to reopen as vaccinations improve. So hopefully the red line will go to a new 2021 lows first. Yeah. Next slide. In terms of Singapore, again, this is just to give some context to all the transmission cases. So when the authorities say that cases are doubling every 7 to 10 days, so you can actually see it in the number, I mean, regretfully. So the last week we got 5,000, then the week before was 2,006, and the week before was 1,002. So this is almost like the third doubling, and what the authorities seem to suggest is that for it to peak, we need, and it could double for at least the 4th or 5th week. So cases could only peak maybe in 2 weeks' time. Again, nobody really knows, obviously, but this is just one scenario. And if it keeps on doubling, so the number of cases every day should be 3,000. So, I mean, hopefully it doesn't, but it could likely be another 2 weeks of very high numbers before it starts to peak and start to taper down, I guess. Next slide. Okay, in terms of the healthcare numbers, so this on the one on the left is the dental admissions. Of course, we monitor this since we are covering Q&M. So this is our monthly. So the red line is the number of outpatient attendances, they call it by the MOH, in 2020. So for us, what we monitor is so long as the blue line is above the red line, that means there's going to be a growth in 2021. So in August, you can see in July, the blue line is above the red line. So what we just need to confirm, I mean, we will try to speak to the company, is just the pre-pandemic numbers. Because the pre-pandemic numbers, which is the green and orange line, is far, far higher than the current blue line. So, but KNS seems to be taking market share. So this is something we need to confirm with them. But that is the thing that, why are the attendances still below the pre-pandemic, which we found a bit curious. We thought we should be maybe at or even higher. The next is just private hospital admissions, and which is still sliding. I think without foreign patients, it's still going to be tough. But again, like we mentioned, companies like Raffles Medical and so forth, they are benefiting from all the government vaccinations and all the PCR test kits. Yeah. Next slide. Okay, this is the RMC. We're not going to do year on year. As you can see, currently 971. This is a 3-month moving average. Whereas a year ago, was virtually nobody was buying any RMC, like ready-mix concrete. But you can just see that it's quite close to pre-pandemic levels, which is very encouraging, considering the construction awarded isn't as high as during the 30 billion per year that was being done in 2019. This is just another chart on TDSR. So the average per month is about 1,000 for the past 10 years. So we are running at, you can see from here, running around 1,002. So this is very healthy, and I think it is self-evident. The blue line started to collapse since 2013 when TDSR was announced. So we're kind of like some of the best volumes since the TDSR time. Next slide. Okay, this is the Singapore job market. We just wanted to have a check, but I guess we have our own equivalent, like the US, like how many jobs were lost since the pandemic. You can see that since the pandemic, we're down about 187,000. I didn't do the stats, but I think at least half of them could be coming from construction. So that shows the precarious deficit of workers that is being faced by the construction sector. The one on the right, which is quite interesting, I guess, for me, is that the orange line is the more important one. So the orange line basically means vacancy to unemployment. So in layman terms, what it means is that for every one person who is not employed, there's almost 1.63. Like the authorities say, every 100 people that's not employed, there's 163 jobs available for them. So it's quite a fun employment market. I guess the demand is more than supply, I presume. So for us, and then the blue line, you can't really see, sorry, but the vacancies is an all-time high. We didn't stretch it, but it's an all-time high. But for us, more important is also the red line. Red line is important because, as we have a buy call on HRNet, So HRNet, on their permanent staffing, the usual like headhunting and so forth. So that is a more important barometer. It means there's a lot of vacancies for PMET, managers and so forth. The higher, I guess, the managerial jobs, which is more important for their permanent staffing business. And of course, the blue line is for everything, for even their flexible. So these are positive lines, I guess, trajectory for HRNet. Next slide. Okay, I'll just do this very quick. This is we just monitor all these data points to see how's the health of the export market. So you can see, although it was a big week, the most recent month, but it's also because pharma is very volatile. But more important is trajectory, what direction wise, Singapore exports growth seems to be even accelerating. So this is a good number, and this can be confirmed by the exports coming out from Korea and Taiwan. So so this kind of gives us confidence that global growth is still very robust. And like I said, Korean Taiwan exports are at decade highs. Next slide. Okay, this is just my quick one on US. So on the left, the blue line basically is the interest rates, and the red line is inflation. So I think the one to note is that the red line, which is interest rates, are always higher, has always been higher than inflation. So basically, you get a real return, right? I mean, if inflation is 2%, you at least, when you pay interest, you want at least a real return of 3 and not above inflation. But what we see right now is inflation is far higher. So someone is being mispriced. So either inflation is really transitory, or the bond markets are kind of underpricing inflation. So we just worry that there could be some perk up in interest rates if inflation continues at these levels. Of course, the argument is how transitory, but we don't think so much about it. We'll discuss more of it in our fourth quarter strategy in October. Okay, the next one is just on the right. We just wanted to show you that the US retail is still very strong, despite the slower number, I guess, in last month. But what you can see is the blue line. So you can see the growth rate in the US retail sales is almost like 20%. And the bar line, the orange, it just shows that retail sales in the US in the longer term trend, the 12 months, it's kind of spikes up. It just gapped up. Of course, in part could be fiscal stimulus, but regardless, you can see that it's still way above trend for the US retail sales. The blue line used to be maybe 5%. Right now it's about 20%. So you can see how strong retail sales, and this is positive again for the global environment. Next slide. Okay, I'll just have 2 more slides. It's a bit long for me today. So for HRNet did a Poems webinar. So I just run point by point. So HRNet is a recruitment agency. They've got almost 700 consultants. So they got this is a huge company. Their market cap is 800, but of which almost half, not half, but almost half is cash. So they got huge 300 million of net cash. So for HRNet, there's 2 parts to the business. There's flexible staffing and permanent. So FS, flexible staffing, what it refers to is, let's say you're social distancing ambassador. If the authorities want to hire thousands, they're not going to go interview everyone. So they will maybe employ HRNet to recruit this staff. And so they're under HRNet's payroll. So HRNet will technically pay the staff monthly, and then they'll get from the authorities maybe 2 months later. So you need the capacity, the infrastructure, and the working capital and the cash which they have to kind of manage the huge volume. The second one is permanent staffing, PS. So PS is like your typical hit hunter. I think we almost should be familiar. So for them, the strength for them is they got in Shanghai, Hong Kong, and Singapore. And what impresses me about the company, we have a buy call 105, is they are a very formidable competitor. Formidable for their flexible staffing because this business needs a huge working capital. So just to give some flavor, their trade debtors is 100 million. So I'm not sure how many recruitment agencies have this kind of huge working capital of how much it's 100 million. And of course, they got technology, infrastructure, and so forth. The second thing is permanent staffing. So permanent staffing, anyone can set up. I think not anyone, but there's a lot of like headhunters with 2 to 3 man teams. But for them, is the scale. They got like almost 700 kind of sales employees. So that once you have the scale, you when you meet clients, especially the huge clients, you know you got a big team to help the client. 20, 30 people can attend a meeting and help the client, number one. And number two, you build experience. So the more placements you do, the more familiar you are with the job and the more confident the large clients you have. So this track record and the size of the sales team is a big barrier to entry. And you can see the barrier entry in the ROE, the attractive model. The reason why I put ROE is above 100 because it depends how you want to compute it, because their share capital is 300 million and their excess cash is 300. So it depends how you want to, you can strip out that they don't need so much cash. So you take out 150, then their working capital their ROE is still above 100, 60 over 150, so about 50% ROE roughly. So that's why of their high barriers at entry, they can earn this high ROE of above. I mean, if you want to calculate, it can be above 100%. It depends how you want to. It's somewhat similar to the closest thing is Propnex. They got such a huge ROE, and one of the reasons is because this is a very asset-light business. If you look at the balance sheet, the fixed assets is only 1 million, and as usual, we always like to joke, all they need is just computer, some servers, some laptops, and then this is the business. But of course, there's a lot of barriers to it. The other thing is that, as we highlighted earlier, you're buying this into a recovering jobs market. So the first half, the PATMI is up 70%. I think Jehui already briefed before. And the sectors they are in is in healthcare, finance, and in government. The table on the right is just they hit like record gross profits in the first half. And next slide, thanks. Okay, this is my last slide. We had a United Hampshire REIT. It did a POEMS webinar. I'm not much insights for me now because this is a US thing. But what they do is, you can see from the picture, they have 18 strip centers, which is basically where, like a Walmart. So if you go to the US, you want to buy groceries, they got this huge Walmart, and then you have to drive there, park your car, and there's probably one in don't know how many kilometer radius. But anyway, so this is mainly a grocery necessity properties. I think the rest, their yields, I think about 9% because they paid a $3 yield. Sponsor is UB. I'm just going to read it out because I don't really have much insights, but their customers are like Walmart, Lowe's, Home Depot, and so forth. I think I'll leave it at that because nothing much from me. For them, the last one is self-storage is a very hot sector according to them, because of these four things: death, divorce, declutter. So these are the reasons why people want to do self-storage, and especially most recently dislocation, because a lot of people are moving away from urban shift to suburban to work. Okay, I think Natalie is in, if I'm not mistaken. I think we shall revert to her. Yeah, thanks, Natalie.
Hi, good morning, everyone. Okay. All right. So today we released our report on our sort of an update / reinitiation of City Development Limited. Okay, next slide, please. Okay, so just going through our 3 investment theses. First of all, would be we think that CDL will be catching a property upcycle with a strong development pipeline. So currently the pipeline stands at 1,746 units. So these comprise of the projects in the table on the right hand side, figure 1. Okay, so this 1,746 units are basically just CDL's own stock. Stake of the project. So as you can see, some of the projects are not 100% owned by CDL. So the unsold inventory would just basically be the percentage stake times the number of unsold units. Yeah. Okay. Okay. So some of the unlaunched projects include the 4 at the bottom, Canning Hill Piers, which is the Clarke Quay redevelopment site, the Northumberland Road government land sales that was picked up just a few months ago, as well as Tingha Garden Walk EC, also purchased this year. And not to mention the last unlaunched project would be the Fuji Xerox redevelopment, the residential component for that redevelopment. So for the two redevelopment projects, we are actually forecasting that CDL will be able to get margins of greater than 30% for these two projects. And this is because the land costs for these two projects are actually relatively low. So for example, the Canning Hill Piers, the Clarke Quay redevelopment, if you recall, the Clarke Quay Mall was actually purchased from the PGIM ARF. Okay, and then after that, a portion of the site was actually sold for this integrated development by Escort Residence Trust. So they actually retain a portion of their Liang Court Somerset and sold a portion for the mixed development project. Okay. And not to mention Fuji Xerox. Fuji Xerox is an asset that has been on CDL's books for the longest time. And because CDL actually adopts a cost less depreciation method, so meaning they state the IP at cost and they will depreciate it yearly. So this actually means that the value of Fuji Xerox on CDL's book is actually very low, somewhere around the 200 million price tag. However, of course, if you were to revalue it, the GDV is somewhere closer to about 1 billion. Yeah, so about 5 to 6 times higher. Okay. So the second investment thesis would be the impending recovery of the hospitality sector. So just to provide some context, CDL's hospitality segment contributed about 192 million, or rather 16.2% of EBITDA in FY18, and 178 million worth of EBITDA in 2019. So obviously FY20 was a very bad year for the hospitality sector, and similarly for CDL's hospitality portfolio. Okay, occupancy actually fell from 74% to 39% in for FY20, and that resulted in 64.5% nosedive in RevPAR. So of course, the revenue for the segment is expected to recover gradually in tandem with the sector, and we believe that there will be some margin improvement owing to CDL's cost containment initiatives as well as digitalization efforts. So some of the cost containment that CDL has embarked on include the reduction of duplication of roles for the hotel portfolio, as well as the digitalization, which of course lead to lower manning cost and lower salary and wages expense. Okay, so we believe that these efforts will also help to return CDL's hotel portfolio to profitability slightly faster. Okay. So overall, we maintain a relatively conservative forecast. We project revenue to grow at a CAGR of 20% from FY21 to FY25. We also expect the segment to turn NPI positive by 2024 before recovering to close to pre-pandemic levels in 2025. The third point would be the asset monetization efforts. So one of those efforts include the listing of a UK commercial S-REIT. So just as a recap, CDL applied for the initial public offering of the UK commercial S-REIT sometime in June 2021. Okay, and we understand that CDL will be the co-sponsor of this S-REIT. So that means there will be two sponsors for the REIT. Okay, so assuming that CDL will take 20 to 25% stake, this could mean that CDL could potentially unlock 526 million to 633 million worth of capital unlocked from the injection of their two UK assets, which are 125 Old Broad Street, as well as Aldgate House. Yeah. So the assumptions for this calculation would be a 20 to 25% stake, and the REIT would be 38% geared, as well as the portfolio would be about 3.5 billion worth. Okay. So now moving on to the next slide. Just a quick update on the Sincere situation. So if you look at our table on the right at the bottom. And if you recall, CDL actually did a major impairment and write down for its investment in Sincere. So the first line item of this table, it says it is where CDL actually impaired the equity stake of their Sincere investment. So in in the second half of 2020, you can see that actually the full 806 million has been impaired. So meaning to say that there will be no other, the entire stake of CDL's investment in CDL has been impaired. Okay, so on during the CDL actually released an SGX announcement just last week on the 10th of September. Okay, and it actually stated in that news release that they will be selling the equity stake of Sincere for $1. So essentially what the message they're trying to send across is that they want to be closing the chapter on this Sincere chapter. Yeah, sorry, turning the page on this Sincere chapter. Also in the announcement, CDL announced that Sincere will be transferring its effective stake, 10% effective stake in this asset, Shenzhen Longgang Sincere Tech Park, to CDL as partial repayment on the loans that were extended. So we estimate that would reduce the CDL's exposure to Sincere by about 70 million, bringing the net exposure as of September 21 to about $52 million. So if you just look at the figure on the top, actually shows the structure of the investment. Yeah. So essentially the whole 10% stake will now move over to CDL, and CDL will hold a 65% stake in this asset. Okay, moving on to the next slide. So to wrap things up, we think that CDL is currently trading at a very attractive price. Our RNAV is about $14.14. So at the current share price of $7.25, CDL is actually trading at a 49% discount to our RNAV. And our RNAV of $9.19, we applied a 35% discount to our RNAV. Okay. So of course, some potential upside for CDL could come from more asset monetization, as well as faster than expected recovery in the hospitality portfolio. Some of the AEIs that CDL have embarked on, those are for assets located in Singapore, as well as one of their malls in which is called Jang Salon in Patong, Thailand. Yeah. So some of these AEIs are expected to help to strengthen the income stream, as well as provide for a stronger portfolio. To wrap things up, we look at the historical price to NAV on the right hand side. You see that the blue line is how CDL has traded with regard to its price to NAV. The red line obviously would be the average, and right now where we are at, CDL is actually trading below the -1 standard deviation line. Yeah, so all in is still a relatively attractive entry. Yeah, okay, so that's all for me. I think we can go into Q&A. Right.
If there's no one there, I'll start first before I pass on my time to my colleagues. So, yeah, I need a moment. Okay, so first up, I think the first question will be on the DBS. So for DBS, I think my outlook remains the same as of last week. I'm still looking for the neckline support over here. Should it break or not? I think on the short term, I think the head and shoulders still remain valid. And since after it breaks off the primary uptrend line, I think since last week I shared about it, I think DBS and the banks are going through a period of consolidation, which is not very good because I think that period of consolidation sometimes may seem that it signal a weak buying momentum and stuff like this. So hence I think that my view remain the same at $26.79 to $27.47 remain a key support region for bounce off. All right. So for the next one, OCBC failed to break the resistance zone as I shared last week as well. And also this corrective kind of like a pattern, a small rising wedge, is some sort of like feels like it's a bearish flag with this bearish impulse, and it has been confirmed. So once it breaks off the 11.36, expect some sort of rebound at $11.23. How strong rebound? I think that the rebound may test $12 before we decide on any further course of action. For Maple Tree Industrial Trust, I think there is like some sort of like a ongoing of like a inside bar or harami. We are not sure, so we need to see how's the price going to trend, going to close. If it happen to close as harami, so we expect some sort of like a further price correction. Ultimately, I think it fails. If you look back on 2nd of August, it fails to break the $3 psychological resistance mark. Hence, there's a further like a down wave, another set of 3 wave down, perhaps to $2.70 before a rebound. Move on to the this was not asked by the Q&A, but I just feel that I need to update on the PSBC because I issued a report on that. So PSBC has officially stopped out at $5.25 as of today because of a strong sell down. Hence, it confirms this double top at the resistance, fail to break up above and then target $6. So I think that price may test the support at 471, if not $4.50 and $4.29 will be the next support region for PSBC for rebound. Also take note that price officially has closed below 63-day moving average. So if it breaks below, then we are officially in the corrective downturn for PSBC. For Tencent wise, I think it successfully break off the inverted head and shoulder based on the what you call it, inverted head, based on my report I issued on stocksbnb.com. But I think this evening star gap below at the major support and resistance zone at 517 and 539, which I explicitly said that after breaking the neckline resistance, it need to clear above to continue on the upside. But unfortunately, this appears to be a bearish reversal. So price actually dropped below, and then despite a bullish upside, I think that price last Friday fails to close above the gap, the mini gap we have to see at 464 region. Hence, I think that further downside may occur for Tencent. All right. So for Jiangxi Copper, which I have issued a report as well, but Jiangxi Copper initially upside was strong, but it faced a tough resistance at 18 to 18.76, which is the previous bearish gap resistance. I consider this as a resistance area again, and then our price subsequently have a strong selling off. We believe that support zone 2 might have a adverse rebound, but strong rebound will actually confirms it. All right, so take a step back. We are seeing a falling wedge, and then this may or may not be a pullback to correct to the base of the falling wedge. So let's observe how the price movement is going to move on when it approaches support zone 2. I think for city development, I think there's a lot of like a focus, especially after what Natalie has mentioned. Believe that the upside has returned temporarily because I think last Monday, actually the double bottom was well supported, breaks off and then close slightly above the 63-day moving average. However, do take note that this is still below the 200-day moving average, and overall trend is still down. But I think that the double bottom was near to the intended support zone at 621 to 634. So hence, any pullback, I would suggest to look for support at 693 or 683 before going up to 804 in the longer term period. 1799 Hong Kong, the downside is still very evidently strong. We believe that this momentum will likely last. We'll find some short-term support at $16 region before upside, and then a corrective sell down on near $24 before returning back to the support zone again. Venture-wise, Venture has closed below the streamline of 63 and 200-day exponential moving average. Looking from the base on momentum, $18 is set to break. So rating for $17.02 to $17.44 as a major support rebound. All right, my views stand clear since many webinars I've been sharing about Venture. Many of you have been asking. So my views still remain the same, that 1702 to 1744 will be the better support region going forward. All right. Capital Corp, same view as last week. Range bound. Any upside need to clear above $5.40. Subsequently, and 556 to target $6.12. Jaffa bearish, bearish again, despite rebounding strongly as support zone 2 on 25th August, but the remaining rebound has been weak momentarily, failed to cross above 0.75. Hence, any potential upside will face kind of like a selling back to 0.580 region, or even lower to 0.5 before a rebound to the upside once again. SMIC, I think multiple testing of the support or the descending triangle support zone at 2170 to 23.15 is likely to weaken it, especially today's sell down. So hence, I think I'm looking for 16.75 to 17.75 as the next targeted rebound support area. Moving on to Fraser Centrepoint Trust, not much of the technicals are being observed. You can see that there's a slew of slowing down momentum near the support. So ideally, it's not very clear cut momentum, but long-term wise, I think 2.02 to 1.94 will be the better rebound zone going forward. Okay, next one, I think Capital DC REIT, not much of the movement as well. Same as what I shared about Fraser Centrepoint. So not really much of a comment right now. ARA logos lock, double top potentially. You can see that RSI has been on the downside already. So there is some sort of like a long-term like decreased momentum, if you can see from larger front since Jan 2021, despite price keep making new high, but I think that momentum has been dry out for ARA logos. Franken as well, bearish divergence. I think we have a double bearish divergence that we are looking at. So expect some, and then if this close as bearish engulfing, then we can expect some major correction going up. Especially if you can see that 1, 2, 3 big wave of like some sort of like N wave, and then you factor in Ichimoku. You can see that prices has been lagging in the momentum. So we believe that there will be the mean reversion correction back to the Kumo at around $2.20 to $2 region going forward for Franken. GKE descending triangle, support zone 1 at 0.124 to 0.127 by break. Hence, next target to look at is 0.113 to 0.117. So with that, I end up my technical presentation. I think there's some more question for my colleague, especially on city development and some sort of Sembcorp Marine rights. So I'll pass my time back to my colleague. Thank you.
Natalie and Terence, can you?
I think I'll take the question maybe because Natalie, even though the CapitaLand one is higher voter, I think she need more time. But okay, I'll just take the next question. Hi, Terence, can you share some insights into any potential downside risks to Singapore banks arising from the Evergrande saga and China intervention into the Hong Kong property? Maybe I'll take the first question first. So some insights into the downside risk. So if you look at China Evergrande's total debt obligations at this moment, at least based on their last reported financials, they have about 1.95 billion Chinese yuan of debt obligations at the moment. When you translate that into Sing dollars, that's about 390 billion Sing dollars. Out of this 1.95 billion Chinese yuan, about 500 billion of these Chinese yuan are bank loans. That means, or 100 billion dollars Sing dollars is in bank loans. That means about a quarter of their total debt obligations, or 25% of their total debt obligations are in bank loans. The rest are bonds, mostly bonds. So of these 25%, there are bank loans. Most of the bank loans, as we understand, are collateralized with the banks. That means that in the event of a default, the banks will be able to try to recover some of their bank loans from the property that has been collateralized. So the actual impact will be a lot more muted. But of course, the 75% holding the bonds will be affected more. But the 25% of loans can be mitigated by the assets that is currently collateralized by the banks. So in terms of the risk to the banks is a little bit more muted, but there could be more systemic risks in the industry, because if Evergrande comes down, there could be other property developers or other construction companies that could be affected as well. So that part of the equation is a little bit of a big risk. Then the second question is, which Singapore banks will be the most negatively impacted by this chain of events? So the short answer to this is banks that obviously have a very heavy exposure into the China-Hong Kong market, the China market rather. So in this regard, the average of the three banks' exposure to the Chinese market is about just about 15% of their loan book is in China. And most of this loan book in China is also in the Greater Bay Area. So their exposure to, I'm not sure if you're really referencing the exposure to China Evergrande, but their exposure to the property market is probably, I mean, they don't give a straight count, but I mean, but we estimate it's probably about 5 to 6%. So it's not that big now in the grand scheme of things, especially for the Singapore banks. But of course, the Singapore banks with the heavier exposure in the China market would be DBS and OCBC. So let me know if I didn't answer your question. I'll go on to the next question. Hi, Terence. Did Temasek mention anything about taking Sembcorp Marine private? No, they did not mention anything about taking Sembcorp Marine private. The compliance takeover offer that we mentioned earlier on in our presentation is in accordance with the Singapore Code of Takeovers and Mergers, and that falls under Rule 14 on the Singapore Code. So what the code states is that a person together with his concert parties, so this person now obviously refers to Temasek, if they hold shares not less than 30%, not less than 30%, but not more than 50% of a company, they will be required to make a general offer on the company if they acquire more than 1% of the company within a 6 months period. So in this case, I think in our slides earlier on, we show their Sembcorp Marine, Temasek actually rather hold 42.6% of Sembcorp Marine before the rights issue. After the rights issue, they now hold 49%. So that's about 7% increase, including their pro rata entitlement and excess. So that 7% increase means that Temasek will now be obligated to make a compliance takeover of Sem Marine. That means that shareholders can tender their shares to Sem Marine at a price that we are not sure yet what price they will do, because they haven't said, they haven't announced the price that they'll be doing it. But we know that the price cannot be lower. Based on Rule 14, we know that the price cannot be lower than the price that they last acquired at. So in that case, that is 8 cents. So they can come out with an offer that is slightly higher. That's possible also, but they cannot come out with an offer that is lower than the price that they acquired when they go up from 42 cents to 49 cents. I don't know if that's clear enough. So that means that the floor is 8 cents, and we in-house, we don't have any coverage on Sem Marine, but we think that could be the price that Temasek will likely put in the offer. So they'll just take any shares that shareholders will tender to them, but they will not take it off the boss, because there's probably some value in maintaining their listing status. So yeah, that's the situation. Okay, yeah, let me just go on and see if there's any more questions for me. Okay, hi Terence, I have a question on DBS. There's market talk of potentially unlocking one of its fintech assets, REIT, worth $10 billion. Fish Gupta also made reference to it in Q2 results preview. What's your take? Take it with a spoonful of salt. Then Shah Singtel has been talking about value unlock of unlisted assets for years, but nothing happens. Okay, so I think that's so the below is a second comment. In terms of unlocking the value of their fintech assets, so they have a few fintech assets, but I don't think the value is 10 billion. But let me check and get back to you. But my own take is the value is not so high. But in terms of unlocking the value of their fintech assets, yes, that's also correct, because that's something that they've frequently talked about also. They're looking to unlock the value of their fintech assets. There's currently under them, there's some crypto assets. They invested in some fintech assets as well. But our understanding is most of these assets that they've invested in is still a little bit early in terms of their maturity. So we don't see the unlocking happening so soon. It will probably still take another 2 to 3 years in the earliest before they will consider any capital unlocking initiatives. Yeah. Yeah, okay, I think that's all from me. I'll hand over to the rest of my colleagues.
Hi everyone. Hi, good afternoon everyone. I see some questions here about CapitaLand investment. So some of the questions I'll read out. Is it a good buy now since it seems undervalued? And a lot of you are asking for the target price for CapitaLand investment. And CICT. Okay, so for CapitaLand investment, unfortunately we have not come up with our valuation for CLI. We hope to do it by this week or early next week. And with regard to the pricing, I believe right now the share price is 293. Okay, and that is at about what CLI's NAV is. So meaning to say it's trading at 1 times. And you know, while we have not come up with our valuation, we definitely think it is worth more than 1 times price to NAV. So actually, if you recall, based on the illustrative, when they came up with the pricing for the payment or of 1 CapitaLand shares, the payment was actually for one unit of CLI, as well as a fraction of CICT shares, as well as 95 cents in cash. So based on that pro forma of 1 times and NAV of CLI, that was actually 2.82. But due to the transactions and the several divestments, accretive divestments as added, that was done throughout 2020, that actually brought the NAV for 1 CLI share up to about 2.92. Yeah, so currently at 2.93 is still about 1 times. And so just to briefly go through our thoughts and on CLI. So of course, with with the decoupling of the development arm, we think that CLI will be a more sharply focused real estate player, meaning to say that the inventory, they will be now focusing on fund AUM growth. So meaning to say growing the AUM of their listed entities as well as the privately held funds. Yeah. Okay, so this also means that they will be more disciplined with regard to how they deploy their capital. The amount of investment properties that will be held on their books, that is purely with the intention of being monetized within the next 3 to 4 years. I mean, you say they are not going to be hogging onto the asset and holding it for the long term. They want to be able to recycle the asset and hopefully deliver some capital gains. So I think for that reason, because as a real estate investment manager, REIM for short, they will be definitely trading at a premium, more than 1 times kind of valuation. Yeah, so that's all I can say right now without actually going having a valuation done. Okay, with regard to CICT, I believe our target price is $2.55. Yeah. Okay. Let me just very quickly right now check the share price for CICT. Okay. Yeah, I think it's about $2, if I'm not wrong. Yeah, $2. Okay, so that means to say that there's still a significant upside for our TP. That being said, due to this distribution in species of CICT shares, we might see a little bit of more volatility for CICT in the near term. Just to rehash some of our thoughts on CICT. Okay. So of course, for those who, just a quick refresher, CICT holds both malls as well as office assets. So some of their office assets are actually located in the core CBD area. Of course, Capital Tower and some of the new Capital Spring, which is the newly developed or rather redeveloped Golden Shoe Car Park, Capital Green. So our thoughts on the office portfolio or the office assets. We have a neutral outlook on the Singapore, or rather on the office sector, and this is because we are seeing some structural decline for the office sector, mainly due to some of the larger occupiers of space actually downsizing their space requirements. Apart from that, I think in general, there's still a little bit of uncertainty with regard to office occupiers' strategy towards their working arrangements in the long term. So a lot of these tenants, they are still on the fence. Most of them have renewed their leases. However, they also are a bit more cautious because they would prefer to have a bit of flexibility baked into their leases. Meaning to say they would try to have extension clauses or break lease clauses written into their leases that will allow them to have a little bit of flexibility when it comes to ending their lease early or expanding the space that they need. Okay. With regard to their office portfolio, with regard to their retail portfolio, so for CICT, their retail portfolio is divided between a good balance between the downtown malls as well as the central malls. So in this period where we are still currently being, so to speak, locked up, and we are not really able to travel, the downtown malls have actually suffered more than the suburban malls. Yeah, but of course, as the more of the population goes back to the office, we expect that the central malls will gradually recover. Also, with the reopening of the borders and the return of tourism, that could help the that could help the downtown malls pick up and recover. Yeah. So I think overall, the way the share price is trading, it is still despite some of the headwinds that are facing the office sector and the slightly a bit more weaker, softer kind of retail sector, there still presents a bit of upside for CICT. Yeah, and hence that also explains our accumulate call. Okay. Yeah, I think I'll pass the time on to Paul for now.
Okay. Yeah, those questions answered. Just click answer. Okay, let me just run through the rest. If how much spillover effect does the China Evergrande? I guess it's no more forever grant. It's probably ever not grant anymore. Situation have in the US market. I think it's going to be very limited. It's going to be more a domestic situation. The other thing is that, do you see this morning's big drop in Hong Kong as a buying opportunity? I don't cover, but I don't. Probably this could be the first round of weakness, right? I mean, the last time we had this in the US, the first gap down, you never go in until you see some because the worry is a bit of a black box. What is the systemic risk? The assets is 300 billion. This is like mini-me of Lehman. Lehman was 600. So you worry the repercussions, then other developers could get hit too. But I guess if you want to play the bet, the safest will still be the banks. But my own gut feel, I don't cover Hong Kong, but you never buy when the first sell down. Yeah, I think you see some exhaustion in the selling. Then by then probably there is some pricing in of this. Yeah. Again, I don't cover Hong Kong, so just take it with a pinch of salt. But just since there was this question. Yeah, because once the worry is a secondary effect. Once you have this, other developers, all the suppliers, bankers, everyone will also want to start to tighten credit. And this could create a snowball for all the developers who are already tight. And then this trigger could create this snowballing. And then you could have another distressed property market where to clear debt, they will have to sell. Then it will kind of snowball into the bank's collateral having been gapped down. Then the bank's asking these companies to top up the equity because the collateral just dropped 20, 30%. And this thing can snowball. So it's very hard to call the bottom. But again, this is one possible scenario. Of course, the difference here is that you got the Chinese authorities that can kind of short circuit it. Okay, I'm just trying to my best to help because I don't really cover Hong Kong. The other one is on HRNet. The amount of cash is a burden to them. Will it pull down its ROE because cash is low? And is there any use of the cash? Yeah, the cash is definitely a burden on the ROE. Their capital, the share base, I mean the share equity, or NAV you want to call it, is about 300 million. The cash is 300 million. I think they could easily pay half of it and have no impact to the business because they don't really need that much cash. But I think they're saving up for M&A. And related to another question, what are the assumptions on HR quoted investments? The market value is down is about 30 million below HR net cost of investments. Yeah, I think they made this acquisition staff line in 2019 for 55 million. I'm not sure. I think it's really mark to market. I think they do mark to market. I think they acquired staff line in the UK and to get into the technology because staff line was very strong in flexible staffing. Flexible staffing means no temporary work and so forth. But what happened was they ran into some financial difficulties because there was some issue with the tax that they paid to the UK government. I think my own view, HRNet has probably gone past that. They've really kind of written it out. I think they're now much more careful with what they do with the quoted investments. I think it's really been marked to market. So you won't have much of a write-off. And even if they do a write-off, the first obvious is not cash, and number two, the market will look past this because this doesn't affect the overall core business. Although the headline numbers won't be that great. Yeah, but the cash, I think they are keeping it for future MAs, and I think after the staff line, they should be, I think, more cautious about what they buy. The next question is Yang Zijiang is eroding by the day. Why so? you know, Yang Chichang, half the business, you know, they've got 11 billion RMB, I think, a book that is for property loans and so forth. So I think market will be kind of nervous because their collateral is property and they also lend to developers. So they are like a pseudo bank, in the sense, maybe one half of the business is like money lending, right? I shouldn't say financing of corporates, not money lending. So I think the market could be nervous of the other half of the business. And in a way, you know, if you want to play Yang Zhejiang, which is the container, you know, maybe you should just buy the Hong Kong. Maybe you could also buy the Hong Kong names or MERS, or no, I think One High. I think One High is listed in Hong Kong, if I'm not mistaken. So maybe some people are just deciding to just buy the container rather than buy a container company with a bank, with a Chinese bank attached to it. Again, we don't cover, but I think these are just my own thoughts. Golden Agri Resource, I don't really cover. If maybe this who can help on the technicals. Yeah. Okay. Why is Yang Zhejiang dropping with a huge order book and poor margin on its business? I don't think it's so much the order book. Usually, these stocks, like any other order book driven business, it is the news flow that drives the stock, not the existing stock of order books. But I think we kind of answered it. I think it could be worries about their property loan book and so forth, because it's always a black box, right? No one truly knows. And yeah. And okay, I hope that is helpful. I'm not sure the rest are whether FA or technicals. Natalie, you want to? Okay, let me just try to do one last one because I saw this. This came in earlier before I pan it over to Natalie. Okay, sorry. I would like to request recording if CSC Global webinar. Yeah. So, apologies. All these listed company webinars, it's not recorded. I mean, we would love to have a recording and keep a big database. That will also be good for us. Sometimes we want to refresh, right? But they don't want, they most of the listcos do not want to have a recording. I guess they worry if anything slip up. Yeah, that is a regretful thing. We also would love to have them recorded. Which unit trust will be affected by Evergrande default? I'm not so sure about the unit trust part. Maybe got to ask the FAs. Yeah, sorry, I'm not very. Yang Zhejiang will face huge material cost pressure from steel price high at multi-year. Not so much. I think they still have some exposure. They do book in some steel exposure when there's an order for ships. But I think that's not such a big issue. I think steel prices are coming down. So probably that was an issue maybe a year early this year, but not so much true. But it is true. I mean, steel is still some exposure to them. Because they don't, once they get the order for ships, they don't immediately cover everything. They do still have some open position, if I'm not mistaken. What's your view on Top Glove? There was a Top Glove results briefing on Friday. I didn't flash it out as a note because there wasn't really anything. They didn't do much Q&A. But essentially, as we highlighted before last week, and sorry if I'm talking about it later. Talking about it again. But what's happening in the glove sector is, number one, there's this, rational or not rational, there's this discussion of a second reading of a windfall tax in Malaysia. So they could be targeting the rubber glove companies. And number two, they're also targeting the banks in Malaysia for, I think, interest waiver for their bottom 50. I'm not sure how they're going to define it, but the bottom 50 lowest income. They think of some interest rate waiver. Again, all this is a bit political, so not good for us to kind of talk too much about it. But that is the one headwind. The other headwind is in China. Chinese are disrupting the prices right now. They're going around aggressively pricing their product, and that is having an effect on the Malaysian glove makers because the customers in US will use this as a bargaining tool to say that the Chinese are offering maybe, I don't know, $30, $35 and you're so high. So the Malaysian manufacturers have to kind of lower down their price to meet with the Chinese, although they're still at a premium. This is mainly nitrile, which is used in the US, but for the emerging markets like Brazil, even China itself, the Chinese are not big in latex. So that's where the Malaysian glove manufacturers still have an edge. So latex isn't so affected by the nitrile. Yeah, I hope that gives a good update. That's a helpful update. Sorry. Natalie, you want to, for HRnet, what is FS and PS? FS is flexible staffing. If you, like say, it's like safe ambassador, you want to do the vaccination program, you get all these flexible staffing people. And permanent is the normal headhunters that I think most of you, hopefully most of you are familiar. Can comment on iFast. I don't have much, but I think there's some talk that they might be disclosing the value of the Hong Kong MPF, I think, or I'm not sure if they already announced. Sorry, I don't really follow, but that is the latest murmurings, I guess, for iFast. Natalie, you got anything? Some questions for you.
I have a question here asking about Escort Trust NAV after replacement. I will need a little bit more clarification. What do you mean by after replacement? Do you mean after accounting for some of the usual capex? The maintenance kind of capex, or what exactly do you mean by replacement? Yeah. So if you can get back to me, then perhaps I can give a better answer.
Yeah, but just to refresh, right? The NAV is all mark to market, right? It's because they're investment property, so everything is really priced at valuation. And maybe you can disclose like some of the things that they sold recently was above the market price. Yeah, thanks.
Yeah. Okay, so for Escort, wait, hold on. Am I in the right file? Yeah, okay, so for Escort, right? Currently the NAV that we have projected for FY21 is $1.14. Yeah. Okay. So yes, Paul's right. For Escort, they actually do their investment property is actually held at or rather they are accounted for at fair value. Yeah. So means that Escort will do half yearly revaluations, and that will actually factor into the carrying value of the investment property, or rather the SRs for this matter. Some of the notable divestments that Escort has done recently, some of the China, let me see if I can pull up the actual, okay, I'll try to share screen on that, but while I'm looking for that, I'll take some of the, another question that I saw, which was with regard to, I can't find the question. Okay, so the question was something along the lines of, are you being too optimistic on CSCT and FCT's target price? According to a Sunday Times article, F&B outlets in CBD are hardest hit with people working from home. So yes, overall, when it comes to the retail sector, we favor the suburban malls. So for FCT's portfolio, their assets are all located in the suburbs, in the heartlands, meaning a lot of them are located in the north side. So your Yishun Woodlands, there's also a Waterway Point. So these are all the assets that are located. They're not really in the central area. So their main catchment would be the households. So for FCT, of course, I think in our valuations, we are projecting a slow, gradual recovery in its occupancy back to pre-pandemic levels. On the ground, what the management has been seeing is that there's talk about this flexible leasing that has been offered to tenants, basically to increase the risk sharing between the tenants and the landlords. Okay, so while that has been more common for some of the other REITs, for FCT, the management has actually sort of pointed out that within their portfolio, they actually do see the tenants who are signing like permanent leases, like a 3-year kind of leases. A lot of them have actually opted out of these kind of risk sharing, meaning to say they still prefer their fixed rent and a small portion of the gross turnover, rather than lower base rent and a higher percentage of the turnover. So what we read from this behavior is that the tenants are actually confident of maintaining their sales and growing their sales. So they do not want a portion of the upside to be taken away when their rents actually vary with their turnover. So that's for the suburban malls. For the retail, for the downtown malls, which is, as I mentioned, half of CFCT's retail portfolio actually is downtown retail assets. So we do, I mean, within our valuations, we have actually forecasted negative reversions, and also of course a slightly lower occupancy level for the REITs, for the downtown retail mall assets. So I think in general, I wouldn't say I'm too optimistic. I think of course the view varies within the retail sector, of course, dividing it between the downtown as well as the suburban malls. Okay. Okay, sorry, there's another follow-up question on that. Pure suburban malls like FCT not immune either, as those outside CBD, not immune either as those outside the CBD, as the job was bigger on weekends with more families staying home, quoted from the same Straits Times article. Common knowledge that F&B is a big contributor to the malls. Yes, F&B is actually a relatively large contributor. They account for about 28 to about 30% of the tenant mix. I think even with one thing that has arisen out of this COVID situation is that we see that actually the footfall has still not yet recovered to pre-COVID levels, meaning that it's still perhaps around 70 to 80% down from pre-COVID levels. That's understandable. However, what we track more closely, or what would be a better indicator of how the tenant sales within the malls would be the tenant sales. So the tenant sales is the one that has actually recovered back to pre-COVID levels. So the implication here is that customers, you and I, we are becoming more efficient when it comes to our visits to the mall. We don't go every day just to buy one or two items. When we go and we have a list to pick up. So in a sense, while the footfall has fallen, there has been other counteracting forces, meaning that we spend more each time we go, or even there is also of course delivery options. Yeah. So I think that for the RSI and the tenant sales, it has actually been keeping within like 8% to -8% to +3% of pre-COVID levels. Yeah, so there is a little bit of fluctuation. Garrel has come back with a clarification on the NAV for Ascott, recent replacement for Ascott. Okay, I'm still not very clear what this means. Do you mean the replacement of assets divested? I'll get back to that when he replies me. Okay, a question about CDL. For CDL, have you factored in the losses on the China investment, or example Sincere? For CDL, actually in our revenue forecast, we have not actually factored in any other contributions from the Sincere investments. So I mean to say, the revenue forecast would be solely from the assets that CDL actually owns. So I think that to answer that question, no, we're not actually impacting, like there are no assets contributing, and therefore there will be no more losses from the assets that are already not contributing. Yeah.
Viren, can you answer this one? What program you use to displace those candle lines? Not sure.
I use TradingView. Thank you.
Yeah, pass the time back to Paul.
Okay. Okay. I'm just running through. Yeah, I think we answered most. Someone mentioned once John Chichang get the contract for building, the company will hedge the metal forward this price. I'm not so sure then. Yeah, not sure how they hedge the steel plates. I always had the impression they could only hedge part of it, not everything. Yeah, but I'll just check through my notes again. Any update? Okay, I will just take this last one. Any update for PropNext? Last target price by Poems was 203. Does the target price still stand? Price seems to be dropping for past 2 weeks. Yeah, I think our price still stands. No change. The third quarter should still be strong. I think the property numbers are still very vibrant year on year. I guess everything dropped like the last 2 weeks. That's my only my only comment. Yeah, the only thing for PropNext is that is they're very domestic oriented. So the next thing is they need to evolve. Next, they need to grow outside Singapore. Yeah, and near term, I think there should be some good dividends. Yeah, but just that the growth ex Singapore will be the key focus for us. I think they already like 40-50% market share, right? So that will be the longer term things that we're looking at. Yeah, I hope that helps. I don't think Sheng Siong, this thing, something asked on Sheng Siong, probably really not sure, but for Sheng Siong, I think no change. Everyone is calling a sell on Sheng Siong recently. I think 2 brokers call a sell. But no, Sheng Siong is just stable. Right, this year will be lower because of the big pantry loading next year. Next 12 months, it could be a sideways movement for us because there is no growth angle for now until they get the new stores reopen. I think that is for us in terms of the momentum. But for Sheng Siong, we still have a buy because we always benchmark it to 18 times. So accumulate, yeah, right now. So there's a bit of a lag now because after last year's incredible jump, the main thing is just that they can't open new stores. So that will probably taper down growth in the very near term until they build that back up. Yeah, but the good thing is their gross margins. The main lever of growth now would be the gross margins continue to expand. They are selling more of their house brands and also the fresh food. Yeah. Okay, we are coming out to 12:50. So thanks everyone. I'm not sure if we missed any of your questions. But no, do send us an email. We'll try our best, or send it through Stocks BNB. We'll try our best to reply. Thank you everyone, because Wei Run has a webinar after this on technicals, US technicals. So thanks everyone for your time. Hope you have a good week and really stay safe out there. So thank you everyone, and thanks again for attending and all your questions. Bye bye everybody.